Bloomberg is just out with its IPO first half wrap. And at a glance, it found that IPOs have gotten off to their best start since 2021, with volumes set to eclipse last year's IPO issuance in the United States. And for more, we're going to bring in Phil Drury, head of technology communications investment banking at Citigroup. And you look at these volumes and you have to ask the first question being, is it going to last?
Well, I hope it lasts, and I hope it increases. Look, whenever you say it's a great start, it's about what's the benchmark. So if the benchmark's 2022 to 2023, it's a pretty low bar for IPO volumes. If the benchmark's 2021, or even frankly 2020, we're well below the volumes that we were seeing. So our view is we'll continue to see a rise in the level of IPOs, and we think that'll pick up meaningfully in 2025 and 2026. Technology and healthcare have really driven the recent re-emergence of IPOs. I think the aftermarket performance has been viewed as mixed, but pricing has been strong when you look at relative value to where the public markets are trading. So we think with more volume, the spread of volatility and elasticity will start to come in, and we'll see more and more confidence in the IPO market.
I noticed you said 2025 and 2026.
Yeah. That
is right after the United States election cycle. How much is the election creating uncertainty for the second half of the year when it comes to equity capital markets?
It creates distraction. I don't think it's about what's the outcome of the election. The public markets have now seen both administrations in power. It's really about distraction. I think we're all going to be, fixated by the live debates, and it just takes portfolio managers away from, what they need to be doing in terms of the extra diligence required to invest in a company which is less heard of and not publicly studied and diligent. So I think the second quarter will continue to be reasonable. Third quarter, as we start to approach that November election period, we'll absolutely see volumes dry down.
What you said implies that the worry is about longer-term uncertainty. You don't know the policy moving forward per se, depending on a future administration. But how much is the worry around just market volatility?
Yeah, well, look, the VIX is at 13 right now, so we're at a historical low in terms of volatility. I think the concern is more cliff downside. And what I mean by that is really geopolitical risk, or what do we not see? There's enough uncertainty in the world today that we do see, and in a way it's unfortunate that the markets have sort of become numb to a lot of the uncertainty that exists. So it's more what we don't see that can have a shock to the system.
Now, if you think about some of the private market valuations you're seeing for some of the highest flying technology companies, think SpaceX, for example, what is the conversation for you looking like under the surface? When you're talking to technology companies that are thinking about an IPO or a sale, why not just raise money privately right now?
Yeah, so the good news is private equity, private companies, they have alternatives. So there's good depth to the private market, both debt financing and also equity financing. But there are a lot of reasons why you may choose to go public. There is an enhanced level of liquidity. You're giving liquidity to employees who perhaps have stayed with illiquidity for 2 years longer than they thought because the IPO market was so quiet in 2022 to 23. It also gives you a public currency to pursue permanent capital and acquisition strategies. So every company has a different rationale to whether they want to continue private and raise capital in the private markets, or whether they transition to the public markets. There's no doubt we're seeing a blurring of the lines. And look, our conversations, public markets have increased. Valuations are now trading at a 10-15% premium to 10-year historical, not 2021 levels. And I think a lot of private companies decided to sit out 22 and 23, remain private, because they capitalized in 2021 when they should have done. But I think the conversation is most relevant today. Private equity is focused on DPI, and they are feeling some pressure from LPs to start to return capital.
There's certainly a real reality there. But what about also these companies that have waited to go public? When you think about that 2025, 2026 timeline that you're looking at here, how big is the universe of that kind of pipeline that has been held back the last 2 years?
Oh, it's very, very significant. I mean, very significant. but the public markets...
Hundreds, 200s.
Yeah, I mean, those levels in terms of capital that can and should be raised. And of course, the longer you stay out, the longer you stay private, these companies have got bigger and they've scaled. And private equity has been quite active doing bolt-on acquisitions, changing the formation of these companies, which means the only real exit is the public markets. There's only so many private equity takeouts that are greater than $10 billion in size. So you need to go to the public markets or, and we've not talked about it, Sonali, the strategic bid comes in. And we've started to see strategic corporate M&A and increasing appetite. So that gives another avenue.
Massive question around how robust this M&A market can be through the end of the year. You haven't seen mega deals. You've seen $30 billion deals here and there coming through the pipe, but there's a lot of uncertainty. You know, we talked to Paul Taubman, for example, very, very uncertain that you'll see a lot of deals through the rest of this year. How much excitement is there around large-scale technology deals right now? Is it possible in this environment?
Yeah, we will see a measured pickup in M&A activity for the remainder of 2024. It's already been a better start, just like the IPO market. It's been a better start for M&A in the beginning of 24 as well. I think with artificial intelligence, it's changing the landscape for many, many companies, not just within technology, but across all industries. So CEOs are reflecting today on, you know, how do we keep moving? How do we transforming? How do we stay ahead? How do we keep our competitive moat? So that will lead to greater M&A activity. Transformational, obviously, antitrust, highly regulated environment is a challenge that CEOs and decision makers need to deal with, which means greater diligence in the early stages, higher level of confidence and certainty. I think AI increases the level of adjacencies as opposed to vertical integration, which may be easier from an M&A regulatory standpoint. But yeah, transformation is feasible. The debt financing markets are healthy. 10 years at 430, but the spreads are very, very compressed today. So we've got a healthy financing environment. We've got equity valuations that are trading well above their lows. And I think we have the catalysts that cause corporations to reflect and change.